Let's welcome on board Jonathan Trizell, Fund Manager at IIFL, joining in right now. Jonathan, hi, good afternoon. Great to have you on a day when ET&I is celebrating its 10th anniversary.
Congratulations.
Thanks so much, Jonathan. Jonathan, just wanted to suss out really what is it that you're making of the RBI governor's commentary. So at a speech at a public forum, he's saying that the Reserve Bank is not going to hesitate taking any required steps for NBFCs, that they're going to ensure financial stability of non-banking lenders. And I guess that is what the market needs to be hearing right now, because from all the chatter that we're picking up, it seems like this is more a crisis of confidence as opposed to a real liquidity crisis.
Yeah, absolutely. I think clearly it's important for a central bank to communicate properly what its intentions are. Perhaps we haven't had that clearly in the past, but yes, to me this sounds like good news. Obviously the market is waiting to hear some news, so I guess we'll see what government does first. But yes, that's undoubtedly good news if they're genuinely saying they'll do what's needed to be done.
Right. Jonathan, in terms of the overall sentiment right now, given that we've got concerns globally as well, and back in India, while it may seem that macros are intact, markets continue to be nervous with regards to perhaps what's happening on specific NBFCs or companies that are highly leveraged. What's your sense in terms of the mood? When do you see things changing? What do you feel is the market is waiting for at this point? What are some of the near-term cues?
Yeah, I mean, the reality is obviously the market has had a very good run for the last few months. And obviously with the election now out of the way and that uncertainty gone, you've had that euphoria to an extent, and now people are waiting and I guess getting more concerned about this short-term growth slowdown. Is it short-term, and et cetera, et cetera. So we're now this phase where the market is waiting to hear what government and central bank is going to do about this growth slowdown, as well as this, I guess, the trajectory for the next couple of years. When we get more certain that the growth might pick up, and the way that the government, will focus on pushing that growth up, then I guess the street will become more confident. But until we get that, there is this nerves, and I guess there is a sort of sense of profit booking after the recent rises we've seen in some sectors.
Right. When we just look at these sectors, any of these stocks sectors which are looking interesting at this point of time, a lot of auto companies have seen a decline. You've liked auto ancillaries. Anything on that front that you like despite the price fall?
Yeah, I think across the board there's some interesting names, particularly in the auto and auto ancillary. We do have some positions there. That we've held them for a while. There's been some pain in the last six months to a year in that segment, but certainly for a long-term investor, these stocks look very well positioned going forward. So I think it's pretty much across the board. Most of the names that are out there have gone through quite a serious derating. So there's certainly that's an area of interest. Who knows if it's the bottom just yet? But I think you've certainly got valuation support on your side.
And in that valuation support then, Jonathan, where is it that you find opportunity? Because money seems to be chasing just those 4 or 5 names within financials and consumption.
Yeah, I guess, there is an element of times when you've got profit booking going on at the moment that people focus on those quality names where management and the company will deliver. So I guess we've refocused on those small segments of the market. But outside of that, as I said, I mean, there's plenty of names that I don't want to dwell, get too focused on individual names, but there are a lot of good quality companies that have derated, particularly in that auto ancillary sector. Now you're getting a bit of profit booking coming in financials and across the market, really. Some of these stocks have moved up very quickly in a very short period of time, and it's a bit of good profit booking is no bad thing.
When we talk about the auto pack, of course, you've spoken about auto ancillary. How would you read into the consumption pack? How would you read into the NBFC issue? Would you just stay away from NBFC and maybe, some of the consumption names that have seen slowdown?
Yeah, I mean, obviously, some of the the earnings from particularly the staple stocks, that it was very apparent in certain companies that there is a consumption slowdown happening. We've discussed that, and you've discussed that many times in the past, the reasons for that. So we won't go back into that. But it's not all across the board. There are pockets of strength still. So it's a very you've got to be focused in the areas you look at. We certainly do have exposure to MBFCs. I think at the moment it's probably still correct to look at the better quality ones, the bigger ones. There's still great opportunities for those guys to gain market share in this current turbulence. So we do have exposure there, but yeah, we're probably a little bit focused on the bigger boys at the moment.
Okay. I wanted to sort of get your view on some of the other, nifty names, whether it be a Reliance, L&T. We saw a little pickup in an L&T, which has softened. Reliance has been just about floating, really, in the last few sessions, and of course, markets wondering with valuations, given the current scenario with regards to the debt picture. What's your sense on some of the market leaders, and where do you feel perhaps the next push might come from?
Yeah, it's interesting. Obviously, Reliance does have I think some earnings issues or temporary ones around the cycle of its main petrochemical business. But as you rightly say, the stock has gone on quite a big re-rating on its other businesses, and I guess it got to a point where there was the push and pull with what was going on with its core business. So I guess we'll have to see what goes on with underlying petrochemical prices before you can take a view on that. I mean, elsewhere, the big stocks, the TCSs and some of the other names, the HDFC Group and a few of the other, L&T, as you rightly say, some of these names have pushed up quite strongly following the election, particularly those industrials like L&T. And I think you can build a good case. There was a valuation case for a number of the industrial stocks, be it the large caps or even the mid cap space. So I think, for us, we have been focusing a little bit more on the cyclical side of exposure, particularly the industrials area. That's worked quite well. And again, with the gains that we saw in a very short period of time, I guess a bit of profit taking is coming back in, which, provides an opportunity for those that might have missed it at the first bite.
Right. How would how would FII now look at India, Jonathan? When you look at global issues, there are trade wars, and prices of iron ore are going up. Probably gold is also going up. It all has an impact on the FII asset class. And you have domestic news, which seems to be not that great in terms of slowdown, in terms of probably rates, what should have been and what are prevailing in the 10-year market. How would a FII look at India at this point of time with the current valuations?
So I think the most important point is India. I think when you compare India to the emerging market pack, India is certainly much more defensive than, for example, a China or some of the other larger emerging markets. So it's viewed as a defensive position that certainly has some growth optionality around it. I mean, just look at where India is in the cycle. Clearly, this is an economy that's been slowing down. We've been in quite a long, extended slowdown, actually. So I think there is a good sort of possibility this economy does kick up, and that's certainly our view going forward. So you've got growth coming up, but then on the other side, from a global trade perspective, India is relatively immune. It's clearly not totally immune, but it's relatively immune from a macro perspective. And as well as a market perspective, if you look at the correlations of the Indian markets vis-a-vis, say, for example, Chinese A shares, then India is one of the most uncorrelated markets to moves with what's going on in China as well. So from all those factors together, plus policy stability that we now have in India, it is viewed as a defensive market with good potential upside, would be my take.
All right, so that's fair enough. Jonathan, are there any other opportunities, in the broader markets from a valuation point of view that you feel could potentially deliver strong returns going forward? Anything that you're looking at recently?
Yeah, so certainly we're looking at some of the mid and small cap names, that have gone through quite a derating. It's still quite difficult to get into some of these names from a liquidity perspective. I think the industrials, although they did run and we have sort of come into a bit of profit taking, continue to look quite attractive to us. And, as we discussed previously, some of the auto and auto ancillary names look interesting. But broadly speaking, the market is an interesting one. I mean, IT was supposed to be a sector that I think everybody thought would underperform, but it's held up quite well. So even, some names in the IT space still look pretty good to us. But potentially, I think if the market does come off a little bit more, then that does provide a good opportunity to add to positions.
Right. Do you have any view as far as gold is concerned, the way it is rallying, the way it is going up? Any view on gold?
Not particularly. I mean, clearly, gold, with its relationship with the US dollar, but other factors as well. I mean, we are in an uncertain environment. I guess it's a different source of potential. If you don't want to buy the US dollar, gold is certainly that there is some optionality there for investors. Traditionally, previously, we used to quite like gold from time to time as a sort of from a risk perspective. But no strong views on direction at the moment on gold.
Okay, but Jonathan, is it an indication by any which way that the world is fearing a recession perhaps, something that big market masters have been warning for the last 2 years now? And, with the growing tension between US and China, you really don't know which way this entire boat is going to head.
Yeah, I mean, we're grappling with two things, aren't we? There's certainly the geopolitics, which has certainly remained elevated for quite some time and doesn't seem to want to back off. And related to that, clearly, is what's been going on in the Gulf and the Middle East. Things could easily spiral out of control there. So an element of caution is clearly sensible. And on top of that, obviously, some of the jobs data out the US and the other economic data, and the pressure that's being put on the Fed to cut rates, which personally I'm not sure is particularly appropriate just at the moment. But so you're grappling with increased geopolitics on the one hand, and as well on the other hand, a big debate about where is the US economy in the cycle? Are we late cycle, mid cycle, et cetera, et cetera? So, I think there is a lot that investors are trying to grapple. And then on top of that, obviously, you've got the seasonality element as well. Sell in May and go away, the old adage. So, yeah, there's a lot going on at the moment.
On that subject, Jonathan, what are you hoping to hear from the Fed 2 days later? Because the meet is going to be on. Does it seem like, again, it's going to be a soft stance? And what are you expecting from the commentary?
So from our perspective, clearly that there is there's been a lot of pressure put on the Fed at the moment from politicians in the US. I think the market has done quite a lot of the work that the politicians are after vis-a-vis falling interest rates. Obviously, we've seen quite dramatic moves in the bond yields in the US. So I think, commentary has to obviously carry on being very aware and alert as to the current data in the US. And obviously, they need to keep investors and commentators informed about views. So, but to our mind, a lot of the work from an interest rate policy perspective has been done already by the markets with those falls in yields. So I'm not quite so sure it's that urgent to be cutting rates just now. So commentary around that is clearly going to be very, very important.
All right, Jonathan, thanks so much for joining us this afternoon. Always great getting a perspective from you on how things stand right now.